Let's look at some results for emissions and financial analysis for this village electrification project. We're going to make some assumptions. First, that the planning horizon is 25 years. We're going to assume 7% inflation on everything. That is on fuel, on O&M, on labor, etc. The debt ratio is assumed to be 70% debt. The interest rate is 10%, and the debt will be out for 20 years. That's the term. So pause the video, complete the finance page, take a look at the emissions page, and then determine if this is a profitable project, if this is a risky project, and what are the GHG emissions reductions associated with this project. Turning to the emission tab here, you can see that the emissions are calculated based on grid electricity in the base case, having an emissions factor of 166 kilograms per megawatt hour of electricity being generated, and having T&D losses, transmission and distribution system losses in the national grid of 7%. You could argue these figures. You can change them if you think they're inappropriate. Maybe the transmission and distribution losses should be a bit higher for Zambia. Maybe the mix of generation sources has changed since this figure was calculated and it should be adjusted. But if you accept that assumption, you end up with an annual GHG emission reduction of around 35 tons of CO2 equivalent per year. You could, of course, increase this a bit by making the photovoltaic system slightly larger, which would mean even less fuel being consumed in the proposed case, and it's this fuel that is responsible mainly for this 3.8 tons of CO2 being emitted in the proposed case. Going to the finance page, we can specify the inflation rate as 7%, the project life is 25 years, the debt ratio is 70%, the debt interest rate is 10%, and the debt term is 20 years. I can look at this as a level 1 analysis. In level 1 I get some basic results, one of which is this cumulative cash flow graph. Initially the total costs are quite small. Why? Because the cost of doing 35 kilometers of grid extension is very nearly equal to the cost of putting in this photovoltaic plus battery plus genset system. So the incremental initial costs are 1 million kwacha roughly. So we see initially here the equity portion of 1 million kwacha, which is 30% of this, so a little under 300,000 kwacha, which is what we see here. Out of savings, we see this ramp up over time, but then here at year 12 to year 13 we see a big decrease. That is of course due to the battery replacement in the proposed case, but then we see savings again up to year 25. So a very complex cumulative cash flow graph. Technically it is a profitable project. Here's the IRR on equity, 73%. For almost any organization that would be a reasonable return on their equity investment. The simple payback also doesn't look terrible at 3.9 years, but the equity payback looks very long, 21 years, because it's based on this crossing of the cumulative cash flow equals 0 line here. That's due to the battery replacement after 12 to 13 years really taking the cash flow negative here. So actually from year 0 to 12 you have a pretty short equity cash flow, rather equity payback period. It would be roughly in the order of 2 years, say, but because of this battery replacement the equity payback gets calculated as being 21 years here. We can look at the net present value here as well by going to level 2 and copying the data we entered from level 1 into level 2. We'll have to specify our discount rate, obviously. I don't know what this should be, but if it were, for instance, a government utility, its goal should be to supply electricity and not necessarily to make huge profits. So maybe the discount rate would be slightly higher than the debt interest rate, or maybe we can assume, say, 12% here. In that case, of course, this is still a profitable project, the positive net present value. We can also see the yearly cash flows here, which are dominated by the battery replacement in year 13. You'll note that the battery replacement is around 9 million or 10 million kwacha. You might say, hey, wait a second, the cost of battery replacement on the cost page was only 4 million kwacha. What's going on here? Why does it cost so much? Well, this is the proposed case battery replacement cost in today's money, today's kwacha. After 13 years of inflation, it works out to about 9.5 million. In terms of riskiness of this project, we can go to the risk analysis here, and we can look at a risk analysis on the net present value. The impact graph here indicates that the most important parameter is the fuel cost in the base case. So that would actually be the cost of electricity. And the initial costs and anything related to the initial costs are of relatively minor importance. I think that's unrealistic. I think what's going on here is the initial costs that RETScreen's risk analysis is dealing with are the incremental initial costs. And it just so happens that the initial cost of the base case and the proposed case is very close, so the incremental initial costs are very small. However, if one of those costs changed significantly, the incremental initial cost could double or triple, or even change sign. So I think that is not being taken into account here, because it's starting out with a very small value for the initial costs, because they're the incremental initial costs. Looking back on the finance page, I would say this actually is quite a risky project. Why? Because of the battery replacement here. The cash flows are dominated by this year 13 battery replacement. In essence, what we're doing is we're deferring a big part of the cost for 13 years into the future, and that cost is the battery replacement. So as long as we can be sure that in 13 years' time there's going to be money available to replace the batteries, this project could make sense. But if that money doesn't materialize, they're going to be left with a system that's operating off the diesel genset for the latter half of this project. And that's going to be really, really expensive. So that is a very risky aspect of this, where you cannot guarantee that this major cash outflow will be satisfied in year 13. In the final video of this series, we will look at redoing this project with RETScreen's Virtual Energy Analyzer.